technical analysis. Introduction to the module. To overcome the time and complexity constraints of fundamental analysis, currency traders frequently turn to a technical approach. Technical analysis makes a simple assumption. The price is a reflection of all market forces. One needs only to track the evolution of prices in any market to know whether the fundamentals, or the weights market participants attach to fundamentals, are changing. This module will introduce you to the tools and methods of forecasting using technical analysis. The fundamental principles of technical analysis. We have seen that fundamental analysis is devilishly complicated. Countless factors influence the demand and supply of currencies, each with varying weights and varying relationships to each other. The analysis can only indicate whether the conditions are favorable for the appearance of demand or supply, not whether it will appear. And it is specific to one market. A Euro or United States dollars trader, having completed a comprehensive analysis of US and UK fundamentals, must start all over again to be able to trade yen or euros. If one assumes that market participants who know or care about any economic development will act accordingly, the outcome of their purchases and sales will be the price. One can think of a financial marketplace as a pool of water. Any change in the economic, financial, or socio-political conditions is like a pebble that lands in the pool. It provokes ripples, very large at the point of impact, but diminishing as they move farther away. Those ripples are the price. The ripples reflect not only the size, weight, and contours of the pebble, but the water's characteristics too. Yet, there is a certain regularity about them. For example, small waves always follow large waves until they dissipate at the edge of the pond. Price. Technical analysis focuses primarily on the price. The price at any given time reflects all market forces, fundamental and human. Today's price movements resemble those of the past. Prices move in trends because market participants respond to fundamentals at different times. Trends continue until they are exhausted. The price means the same thing in all markets at all times. Volume and open interest. The term volume refers to the amount of currency traded within a period. On an exchange, the volume of securities traded is documented and published. In a decentralized market, like the forex market, volumes must be estimated. Banks and other online service providers typically track trading volumes on their platforms. Admittedly, no one platform can capture the entire market volume. What matters for technical analysis, though, is the relative volume, not the absolute. Was it higher in this period or the last? Are volumes rising or falling? Is the volume greater when the price rises or when it falls? Volumes can indicate market participants' awareness of a new condition. Open interest refers to the size of outstanding positions. These are positions that traders have entered but have not yet closed. Exchanges publish this information, but it is harder to come by in decentralized markets. Once again, though, online platforms do track the users' most popular trades. Increasing open interest indicates that new money is flowing into the market. Types of charts. Technical analysis uses price information displayed primarily in graphical form, price on the vertical axis and time on the horizontal. Time frequency is most often daily, but, depending on the perspective an analyst wants to take, it can be monthly, weekly, hourly or even minute to minute. These graphics are known as price charts. Line chart. The line chart is the simplest form of the price chart. It records a single price at the same moment in each period. A daily chart, for example, might capture the last quoted price of the session or the price at midday. Bar chart. Each entry on a bar chart reflects the full range of prices traded during the period in a single vertical line, as well as the first price, opening price, and the last, closing price. The highest point of the vertical bar is the highest traded price or the highest bid of the period. The lowest point on the bar is the lowest traded price or the lowest offer of the period. A small horizontal mark to the left of the bar indicates the opening price. A small horizontal mark to the right of the bar indicates the closing price. The advantage of bar charts over simple line charts is that one can instantly recognize volatile days and regularly revisited price levels. Candlestick chart. A candlestick chart captures the same information as a bar chart, but displays it in a slightly different way. Instead of small horizontal marks to indicate the open and the close, candlestick charts represent the range between these two prices as a solid block, called a body. In periods where the close is higher than the open, up periods, the body is white or green. On periods where the close is lower than the open, down periods, the body is black or red. A vertical line continues to indicate the trading range of the entire period. However, this line now exits the body at the upper and lower end. It is to this wick-like feature that the candlestick chart owes its name. Trends, support, and resistance. The premise that prices will always move in trends has its roots in the observation of traders, not of fundamentals. People can be very reluctant to change their beliefs. Even when the evidence of changing conditions is apparent, people often cling stubbornly to their prior beliefs. So when new economic data arrives in the market, its weight might only be partially acknowledged immediately, the remainder being slowly priced in during subsequent periods. Sometimes traders must incur considerable losses before they change their minds. Trader psychology. Consider a situation where traders speculate on a rising pound and take long positions in GBP by USD. Let's say the counterparties to these transactions happen to be British tourists heading off to Miami on holiday, US technology firms repatriating the receipts from their London retail stores, and UK investors buying stakes in an oil refinery in the Gulf of Mexico. All the buyers in those transactions are short-term, speculative players, while all the sellers are long-term strategic players. The former must resell their pounds at some point. They hope to do so with a profit, but they must still get out, even if there are only losses. The latter, in contrast, do not need to rebuy. Indeed, unless US to UK trade and investment starts to flow in the opposite direction, there might never be a long-term GBP or USD buyer. Those speculative traders may well be aware of higher investment yields in the US or news about increasing UK imports of US-produced goods. Yet, they might still be reluctant to change their minds about the wisdom of their cable long positions. So, although they should probably sell pounds on such news, they don't. Hence, the data is not fully reflected in the price yet. Often, only painful losses will shake those traders from their erroneous beliefs. When these traders ultimately realize that they are wrong with a trading position and need to exit, they try to do so without incurring any loss. Those in the long cable position, for example, will ultimately recognize they were wrong when the price starts to fall. Yet, they do not want to record a loss. This loss aversion tempts them to wait for the price to rebound to the level where they previously bought to escape loss-free. The price where they had bought, former support, has now become the price at which they want to sell, future supply, with comparable volumes. Lines of support and resistance. Support and resistance are, respectively, price levels where one can expect to see more abundant demand and supply. Sometimes this demand or supply is enough to prompt the reversal of a price trend. One of the first rules of technical analysis is that broken support becomes resistance and vice versa. The trend line. Trends unfold in a series of zigzag waveforms and prices, just like the ripples in a pond. A straight line on the price chart connecting the significant peaks or troughs illustrate the direction of the trend and can often predict the nearby support and resistance. Percentage retracement. Speculative traders on the losing side of a price move do not always have the opportunity to escape without loss. Sometimes the price correction is not 100%, and the traders grow impatient. For this reason, technical analysts anticipate supply and demand at other percentages of the prior price move. The most famous retracement percentages are approximately 1/3, half, and 2/3 of the previous price move. Trend reversal pattern. In addition to trends, support and resistance, technical analysts look for patterns in the evolution of prices. These are known as chart formations. Of particular interest are those formations that signal a possible reversal of a trend. Head and shoulders. One of the most famous reversal patterns is called the head and shoulders. A head and shoulders top announces the end of an uptrend. Its 3 consecutive price peaks, the second, the head, higher than the other 2, the shoulders, makes it easily recognizable. A straight line connecting the lows on either side of the head is called the neckline. This line, extrapolated to the right, provides a reversal signal once it is broken. A head and shoulders bottom is the inverse of this formation. Double top and bottom. Another easily recognizable reversal formation is the double top. It is composed of twin peaks at approximately the same price. Technical analysts draw a horizontal line at the price trough that separates the 2 peaks and extrapolate it to the right. The breach of this line gives the reversal signal. The double bottom is the inverse of this formation. Triple top and bottom. The triple top comprises 3 peaks at approximately the same price. This formation, like the head and shoulders, has a neckline that must be broken to signal the reversal. The triple bottom is the inverse of this formation. Rounded top and bottom. A rounded top is a slow gradual reversal of direction. It is created when a series of fractionally high peaks give way to a series of fractionally lower ones. The formation has no specific number of peaks and no clear signal of its completion, which is unfortunate because many trends end this way. The inverse of this pattern, the rounded bottom, is known as the saucer formation. Diamond formation. The diamond formation gets its name because the deepest trough in the formation immediately precedes or follows the highest peak. To the right and left of these extreme prices, swings are oscillations of shrinking amplitude. Technical analysts use straight lines to enclose the oscillations either side of the extremes, which give rise to the characteristic rhomboid shape. A diamond formation can occur at both tops and bottoms. Trend continuation patterns. Identifying top and bottoms is a source of great satisfaction for most traders, which probably explains why they spend so much time looking for them. Yet, buying near the low or selling near the high is not necessary for long-term success. Indeed, as markets spend vastly more time in trends than they do in reversal formations, recognizing when they are not reversing offers far more trading opportunities. Several consolidation patterns indicate that the price direction will likely not change but resume. Flag formation. A steep upward or downward trend will often pause for breath halfway. The flag formation is sometimes indicative of such a pause. It is composed of a series of comparatively small price swings that progressively pull the price in the opposing direction. Halfway into a steep upward trend, for example, these swings would result in a series of slightly lower lows and lower highs. Graphically, the price development looks like a flag on a windless day attached to an almost vertical flagpole. The formation concludes when the price records the first higher high. The trend then resumes. During an upward trend, the formation is called a bullish flag. The inverse formation, during a downward trend, is called a bearish flag. Pennant formation. Similar to the flag formation, in that it occurs approximately halfway into a steep upward or downward price move, the pennant is characterized by a series of shrinking horizontal oscillations. The signal for the trend resumption comes as the first high in an upward trend or lower low in a downward trend. Triangle formation. The triangle formation is a broad series of price swings that take the shape of a triangle. The formation can occur at any time during a price swing, not only in the midst of a steep upward or downward price move. Technical analysts define the sides of the triangle with straight lines that connect at least two price extremes at the upper and lower borders. The breach of a border in the direction of the trend signals its resumption. Wedge formation. The wedge formation is similar in shape and significance to the triangle formation. Although the upper and lower borderlines converge, they both slope in the opposite direction to the trend. Rectangle formation. The triangle formation is a clearly defined horizontal trading range. A break of the border in the direction of the trend signals its resumption. A break in the opposite direction might indicate a trend reversal. Indeed, such a reversal formation could resemble a double or triple top. Gaps. Gaps occur when a market opens at a price outside of the range established on the previous day. Gaps provide crucial information about the previous day's speculative traders. Following an upward gap, every outstanding long position from the previous day must be winning, and every outstanding short position must be losing. The opposite is the case for a downward gap. The ensuing price development exposes the balance of winners to losers and longs to shorts. Common gaps. In the 24-hour forex market, gaps are only possible between Friday and Monday. Yet, there are occasions, during the low-volume periods at the end of North American business, but before the proper start of Asian trading, when price quotes can shift sharply without any trading taking place. This development would qualify as a common gap and is without significance. Breakaway gaps. When losers outnumber winners following a price gap, a scramble to unwind open positions ensues. Following an upward gap, for example, the losers must urgently rebuy their short positions. The price can hardly weaken. It is rarely able to dip into the price range the gap left behind. Typically, the price rushes higher. A gap can signal the start of a new trend when it emerges from a lengthy consolidation. In this case, it is known as a breakaway gap. Runaway gaps. Gaps can also occur within established trends, in the same direction as the trend. The implications are the same as in a breakaway gap. When speculative losers in this trend outnumber winners, the trend continues with urgency. This gap is known as a runaway.
Exhaustion gaps. Exhaustion gaps also occur within an established trend, in the same direction as the trend. However, the speculative winners from this gap outnumber the losers. This balance means the scramble is to take profits. Following an upward gap, for example, profit-taking easily pushes prices back into the range left behind by the gap, even back into the previous day's range. Such gaps can sometimes indicate a complete trend reversal.
Mathematical trading methods. Even technical analysts concede that chart analysis is more art than science. Whether a price pattern is one formation or another is sometimes a matter of individual interpretation. One formation can also sometimes morph into another with a few additional price points. While adhering to the behavioral underpinning of the approach, analysts try to introduce more scientific rigor to their work using mathematical trading methods. These methods use past prices and numerical derivatives of the price. They interpret these inputs consistently and objectively, and then generate testable buy or sell signals. Moving averages. The first derivative of the price is the arithmetic mean. The average of past prices, calculated regularly, provides an indisputable argument for the direction of the trend, at least over the selected sample period. A 5-day moving average informs us about short-term trends. A 100-day moving average takes a broader perspective. Of course, moving averages only refer to the past, not the future. They only indicate what the trend was, not what it will be. Still, analysts use moving averages to generate trading signals. Examples of these signals include a reversal in the direction of the moving average, the price crossing over its moving average, a short-term average crossing a long-term average. Momentum indicators. Momentum indicators essentially calculate the second derivative of the price, namely the rate of change. One can gauge whether a price trend has strengthened or weakened by observing several popular measures. Momentum, rate of change, relative strength index, directional movement index. The method of calculation of each of these indicators is slightly different, yet they all capture the same feature and are interpreted in the same way. Analysts are reassured about the sustainability of a trend when a new extreme in momentum accompanies a new extreme in prices. Pattern recognition indicators. Pattern recognition indicators convert visible chart patterns into a numerical form. For instance, technical analysts have observed that prices tend to close at the upper end of the day's range when markets are about to bottom, and at the lower end when they are about to top. This intuition is the basis of indicators known as stochastics. Other examples of pattern recognition indicators include Larry Williams percent R, Commodity Channel Index, Bollinger Bands. Stop and reverse indicators, SAR. One kind of mathematical method uses no price input other than the extreme price. Based on the highest or lowest price attained within a trend, the model calculates the path of the trend reversal in advance. An example of such a method is the parabolic system. It assumes that trends develop exponentially, in other words, slowly at first, then increasing in speed. From a given starting point, the parabolic system can plot the entire path of the counter trend. It needs only the user-defined exponential growth factor. As long as the emerging trend adheres to the predetermined path, analysts assume the trend is intact. Otherwise, the position must be stopped and reversed. Summary. Technical analysis is both comprehensive and flexible. These characteristics have afforded its popularity in the forex market, even among those who do not subscribe to its often subjective methods. At its heart, though, the approach seeks to capture elements of human behavior, which is reliable and therefore predictable. Broken support becomes resistance, and vice versa. Prices move in trends. Price charts help to visualize trends and trend reversals. Derivative methods reveal hard-to-see price characteristics. Mathematical methods generate objective testable trading signals.